Understanding the Dow Jones Industrial Average, DJI. The Dow Jones Industrial Average, DJIA, is a well-known stock market index that has been tracking the performance of 30 large U.S. publicly traded companies since the late 1800s. The index provides a snapshot of the overall stock market's health and is widely regarded as a bellwether of the U.S. economy. Recently, there has been a surge of interest in the DJIA, as evidenced by the latest Google Trends data, which shows a steady increase in search volume for the term Dow Jones over the past 7 days. This interest may be driven by the recent volatility in the stock market and concerns about inflation and rising interest rates. For investors looking to capitalize on the DJIA's performance, two popular options are DIAx and DIA. In this article, we will explore the differences between these two options and provide insight into how they can be used to build a diversified portfolio. DIAx, leveraged investment with options contracts. DIAx is a relatively new investment option that allows investors to invest in the DJIA using options contracts. The option contracts provide leverage, which allows investors to make more significant profits from smaller investments. Investors can choose from various options, including puts, calls, and spreads, which provide flexibility in building a customized investment strategy. DIAx trades on the NYSE ACA and is designed to track the DJIA's performance while offering additional options for investors. However, investing in DIAx also comes with risks. Because of the leverage provided by the option contracts, there is an increased risk of loss, especially in volatile markets. Additionally, DIAx is a relatively new investment option, and investors may require significant knowledge and experience to understand and use its features effectively. DIA, ETF for diversification and stability. DIA is an exchange-traded fund, ETF, that seeks to track the DJIA's performance. It invests in all 30 of the DJIA's stocks, providing investors with exposure to a diversified range of industries and companies. DIA is a relatively stable investment option, making it ideal for long-term investors. It is also a low-cost option, as ETFs typically have lower fees than traditional mutual funds. However, investing in DIA may have limited returns, making it less attractive to investors who are looking for higher returns. Additionally, while DIA is designed to provide diversification, it only invests in the 30 companies in the DJIA, which may not be enough for some investors. Conclusion: building a diversified portfolio with DIAx and DIA. Investing in the stock market can be complex, and choosing the right investment option is crucial to maximizing profits and minimizing risks. While DIA and DIAx are both investment options that allow investors to invest in the DJIA, they have different benefits and risks. For investors looking for a leveraged investment strategy with customizable options, DIAx may be a suitable option. However, it is important to note the increased risk associated with this investment option. On the other hand, DIA provides exposure to a diversified range of companies and is a relatively stable and low-cost investment option. It may be more suitable for long-term investors who are willing to accept limited returns. Ultimately, building a diversified portfolio may involve a combination of these two investment options, as well as other investment vehicles, depending on an investor's goals and risk tolerance.